A $220 automatic investment every 2 weeks can become $5,720 a year and still feel like nothing is happening. And that miserable feeling is often proof the system is working. You skip the phone upgrade, make coffee at home, buy the cheaper groceries, and your account still has the nerve to look unimpressed. Stay with this, because the point is not to pretend early investing feels rewarding. The point is to understand why it feels so small, why that does not mean it is failing, and how to keep going long enough for the portfolio to start doing work your paycheck used to do alone. Take a normal American household. A 35-year-old makes decent money, not rich money. Payday hits Friday. Before the money even feels real, a few percent goes into the 401k. Maybe another transfer goes to a Roth IRA at the end of the month. Then rent shows up. Groceries cost more than they used to. Car insurance renews like a financial ambush, and the phone company whispers, only $33 a month, because every bad decision now shows up politely in monthly installments. So you do the responsible thing. You keep the old phone. You buy store-brand cereal. You skip the $6 coffee. You move the vacation because flights are cheaper. Real sacrifices, real trade-offs, real adult budgeting, which is basically saying no to yourself in different fonts. And after a year of that, the statement may show steady payroll deductions, a modest employer match, and a balance that still does not feel like a victory. Maybe the market helped. Maybe a bad quarter swallowed the gains. Either way, the number can look less like wealth building and more like a receipt for 12 months of discipline. This is where early investors get angry, and the anger makes sense. You expected investing to feel like money multiplying. What you got was an account proving you kept showing up while every paycheck offered easier ways to spend. But that is not proof the plan is broken. That is the flatline phase. In the beginning, your deposits do almost all the visible work. If you have $5,000 invested and the market gives you a strong 10% year, that's $500. Nice, but not life-changing. If $220 comes out of every biweekly paycheck, your own cash flow adds $5,720 in that same year, before any match or extra contribution. So your brain sees the sacrifice more than the growth. It feels like the paycheck is pulling the wagon, because at first, it mostly is. That is the cruel design flaw. The sacrifice is loud. The growth is quiet. A paycheck gives immediate feedback. You work 2 weeks, money arrives. A bill gives immediate feedback. You pay it, the company stops threatening you with late fees. Very generous of them. A purchase gives immediate feedback. New shoes, new phone, new dinner, new whatever. You get a feeling right away. Investing is more like planting a tree in a parking lot and getting mad that it did not provide shade by Thursday. The early work matters, but the result is not built to entertain you on schedule. Your brain wants straight lines, effort in, reward out. Investing gives delayed visibility. Boring actions stack quietly, then years later the curve bends in a way that looks obvious only after it already happened. The market makes this harder because it does not pay returns like a salary. For the 10 years ending December 31, 2025, the S&P 500, including reinvested dividends, compounded at about 14.8% annually. That sounds incredible. But from January 1, 1970 through December 31, 2025, the compounded annual return was closer to 11.3%. And inside that long-term number were strange years. Since 1970, the best 12-month stretch was up around 61%. The worst was down around 43%. The point is not that you should expect 14.8%. The point is that the market does not care about your need for steady encouragement. It can reward you in bursts, punish you in the middle, move sideways long enough to make everyone online sound profound, and then suddenly jump after half the people already quit. That is why the first few years are harder than the spreadsheet admits. A spreadsheet sees clean rows and neat percentages. Real life sees a birthday dinner you skipped, a cheaper gym, a car repair paid in cash, and an investment account that still looks like it is clearing its throat before saying anything useful. So the first rule is practical, not motivational. Protect the money your life depends on, and automate the money your future depends on. Here's the annoying math behind why the first win looks so small. If you invest $10,000 and earn 5%, you gain $500. The next year, if you earn another 5%, you earn it on $10,500, not just the original $10,000. That creates $525. Yes, the big magical extra amount is $25. Congratulations, your money earned money, and the money earned enough for one takeout order, if you skip delivery fees. Not exactly fireworks. But that tiny extra $25 is the mechanism beginning to show itself. Returns are starting to earn returns. It means your past gains can become part of the pile that creates future gains. The machine is small, so the output is small. That does not mean the machine is fake. Scale the same percentage and the feeling changes. 5% on $20,000 is $1,000. 5% on $100,000 is $5,000. 5% on $300,000 is $15,000. The percentage did not get smarter. The account got bigger. This is the small number problem. Early returns can be good in percentage terms and still look weak in dollars because the base is small. And because the dollars look small, people assume progress is small. But early investing is not mainly about feeling rich. It is about buying years that cannot be purchased later. You can try to invest more later. Sometimes that works. Sometimes life laughs at that plan. Kids, layoffs, housing costs, medical bills, aging parents, burnout, a car that decides to become a monthly subscription to the mechanic. Later is not some open field where every dollar is easier. Time is the part you cannot order overnight. That is why two people with similar incomes can end up in very different places. It is not always because one picked the perfect stock or followed a Wall Street wizard in a vest. Sometimes one person kept adding money during the boring years while the other waited until investing finally felt urgent. J.P. Morgan Asset Management has a retirement modeling example that makes the gap clear, though it is only a modeled scenario using its assumptions and simulations, not a guaranteed outcome. In one early and consistent path, the ending portfolio lands around $685,200. Another lands around $317,900. The difference is about $367,300. The exact numbers depend on assumptions, markets, behavior, and the future being its usual uncooperative self. But the lesson is sharp. The difference between staying consistent and delaying often does not look dramatic at the start. That is the emotional trap. The person who quits in year 2 may not feel reckless. They may feel rational. The account is small, the returns look unimpressive, cash feels useful. The car is old, the apartment needs furniture, a family trip feels more meaningful than another automatic transfer into an account that seems to blink slowly and do nothing. For years, the quitter can look reasonable. Then the curve starts separating. Not because the consistent investor predicted the Fed, inflation, elections, recessions, oil prices, AI stocks, bank headlines, or whatever the market was panicking about that week. At some point, a normal market move on the accumulated balance can exceed the entire year's fresh contributions. A 10% year on $150,000 is $15,000. If you contributed $9,000 that year, the portfolio produced more than the paycheck contribution did. That handoff changes the experience. That is the patience gap. Not patience as a personality trait, like you were born calmly reading bond reports by candlelight. Patience as a system, a payroll deduction, an automatic transfer, a boring rule followed before your mood gets a vote. Now, cash complicates this because cash feels better. Cash does not send you a red number on a random Wednesday. Cash does not drop 18% because investors suddenly remembered interest rates exist. Cash sits there. It looks stable. It feels responsible. And some cash is responsible. If rent, groceries, insurance, medical copays, or car repairs depend on money, that money should not be riding the stock market to prove a point. Emergency cash is not lazy. It is protection. The Federal Reserve keeps asking basic household questions for a reason. Can adults handle a $400 surprise expense with cash or the equivalent? And do they have rainy day funds for several months of expenses? Those are not fancy questions. They are life questions. A portfolio does not help much if one blown tire forces you to sell investments at the worst possible time. So the first cash bucket is survival cash, current month checking. Then emergency cash, ideally building towards several months of necessary expenses. Necessary means housing, utilities, food, insurance, minimum debt payments, transportation. It does not mean 3 months of pretending every weekend is a destination wedding. But after that buffer is handled, excess cash can become a comfort tax. In 2026, interest rate policy matters because the reward for sitting in cash can change. Cash yields rose when rates were higher, which made savings accounts and money market funds feel unusually satisfying. But if cash yields drift lower while inflation still nibbles at prices, a giant cash pile may feel safe while quietly lowering your long-term ceiling. Cash is like keeping money in the driveway, useful if you need to leave quickly, not great if you expect it to drive itself across the country. Once emergency money is separate, every extra dollar needs a job. Some dollars protect you from bad months. Some buy future growth. Some reduce expensive debt. The mistake is making every dollar do the emotional job of make me feel safe today, because then your future gets underfunded while checking looks smug. Stocks can still be important for long-term retirement portfolios, but the amount should fit your situation and time horizon. A 35-year-old saving for retirement has a different risk budget than someone who needs money in 3 years for a down payment. Same stock market, different job for the money. This is where the portfolio becomes a system, not a mood. Start with the obvious thing people still skip. If your employer offers a 401k match, capture the match before optimizing anything cute. A match has rules, vesting schedules, fees, and plan details, but walking past matching money because you are waiting to feel ready is like refusing a raise because the envelope looks boring. Then use tax-preferred retirement accounts where available. 401ks, traditional IRAs, Roth IRAs, HSAs if eligible and appropriate. Each has rules, limits, tax treatment, and withdrawal restrictions. You do not need to become a tax code hobbyist. You do need to know which accounts are available before throwing everything into a regular taxable brokerage account because the app looked friendly. Then automate a contribution that can survive a normal bad month. That phrase matters, a normal bad month, not a catastrophe. A normal bad month is the month with the higher electric bill, a dentist copay, and a birthday gift you forgot. If your contribution is so aggressive that one ordinary inconvenience makes you cancel it, the number is too fragile. Pick a contribution you can keep, then schedule increases, even 1% per year. If your raise hits in March, set the 401k increase for April. If rent renews in September, review after you know the new rent. Make the system adjust when life changes, not when you feel inspired during a Sunday night financial panic. Find the money like someone who lives in the real world, not like a budgeting app that thinks the answer is stop having fun. Get insurance quotes before renewal. Check whether your phone plan matches your actual data use. Move 5 grocery items you do not care about to generic: pasta, oats, spices, paper towels, basic medicine. You do not need to turn dinner into punishment. Just stop paying brand tax on things that do not matter to you. Purchase timing matters too. If your laptop works, do not replace it in May because you are annoyed. Wait for sales, reimbursement windows, or a real failure. If flights are flexible, shifting travel by a week can free up more than one monthly investment contribution. If takeout is the leak, do not pretend you will cook every meal forever like a financial monk. Replace 2 delivery orders a week with a cheaper pickup option or grocery store prepared meal. The point is not moral purity. The point is turning invisible spending into visible ownership. If you free up $75 a month, that is not embarrassing. That is a new automatic transfer. If you free up $150, even better. Small contributions feel small because they start small. The trick is not to disrespect the beginning. Diversification is the next boring word that protects you from yourself, Diversification simply means you do not bet your entire future on one company, one sector, one theory, or one dinner party stock tip from someone who says do your own research after clearly not doing any. Broad funds, a mix that fits your time horizon, bonds or income assets where appropriate, and a plan that does not require you to predict every headline. That is the grown-up version. In 2026, with Fed policy uncertainty, shifting liquidity, and market volatility still in the background, no single asset class is always the hero. Cash protects short-term needs, bonds or income assets can act as ballast, stocks offer long-term growth potential. The right mix depends on when you need the money and how much volatility your life can actually absorb. That last part matters more than a personality quiz. Everyone says they can handle risk when the chart is green. The real test is whether the portfolio forces a panic sale when the market drops and your transmission fails in the same month. So keep near-term bill money out of stocks, keep emergency cash separate, match stock exposure to the time horizon. Retirement money decades away can tolerate discomfort. Money for taxes, tuition, rent, or a home purchase soon does not belong in the market looking for excitement. Now, how do you stay consistent when the account does not applaud? You stop grading the plan by daily balance changes. Daily balances are mostly noise, especially early. They turn investing into a slot machine with worse lighting. You log in, the number is up, you feel smart. You log in, the number is down, you feel betrayed. Neither feeling is a plan. Track controllable metrics instead. Did the contribution go in this month? Good. Did your invested percentage move from 6% to 7% this year? Good. Did emergency cash move from 2 weeks to 1 month, then 2 months, then 3? Good. Are you using available retirement accounts? Are fees reasonable? Does the asset mix still fit when you need the money? Use one annual review, not every morning, not every red headline. Once a year, check contribution rate, account type, employer match, asset mix, fees, emergency cash, and time horizon. If life changed, adjust. New child, new mortgage, new job, higher insurance, lower debt, different goal, those are real reasons. A scary market month is not automatically one. The annual review protects you in both directions. In bad markets, it slows panic. In exciting markets, it slows overconfidence, because greed ruins plans too. A rising market makes people think they are financial visionaries because their index fund went up. Suddenly, the diversified plan looks too slow, and here comes the concentrated bet on whatever everyone online is worshiping this week. The system has to survive boredom and excitement. The years that test the plan do not announce themselves politely. Sometimes the market drops 20% and every headline starts speaking in disaster poetry. Sometimes nothing crashes, but nothing goes anywhere long enough that investing feels pointless. Sometimes your friend makes fast money in crypto, options, real estate, or one lucky stock, and your diversified retirement contribution feels like eating steamed broccoli at a casino buffet. This is where the return range matters. A long-term average does not mean average every year. Volatility is not a glitch, it is part of the price of seeking growth. Staying consistent does not mean ignoring risk. It means designing the portfolio so risk does not corner you. If losing your job would force you to sell stocks to pay rent, your cash buffer is too thin. If a 30% drop would make you abandon the plan, your stock allocation may be too aggressive for your real tolerance or timeline. If you are carrying high-interest credit card debt while investing tiny amounts in a taxable account, the math may be telling you to attack the debt first or split the strategy carefully. Paying 20% interest while hoping for market returns is not confidence, it is expensive optimism. There is also a difference between pausing strategically and quitting emotionally. If income drops, you may reduce contributions while protecting emergency cash. Fine. If a medical bill hits, you may redirect money for a few months. Fine. The danger is when a temporary adjustment becomes a quiet exit because the account never gave you enough excitement to come back. Create a restart rule before you need it. If contributions drop, set a calendar date to review them. If you stop extra investing to rebuild cash, define the cash target. If you pause after a job loss, restart with the first full paycheck after reemployment, even if the number is small. Do not leave the decision floating in emotional fog. Small restarts matter because the habit is part of the asset. Eventually, if you keep feeding the machine, the account behaves differently. At $100,000, a 10% year is $10,000, roughly the same as contributing about $833 a month for a year. At $300,000, the same 10% move is $30,000, which can be larger than many people's annual contributions. Nothing magical changed. The rules did not suddenly become generous. Your base became large enough for percentages to matter in dollars. That is the takeoff point people mean when they say compounding is powerful. But they usually skip the annoying part. You do not get the visible part without surviving the invisible part. The boring years are not wasted. They make the visible years possible. This is why early investing feels so unfair. You do the hardest psychological work before the account has enough size to reward you emotionally. You give up real spending today for future growth that still looks tiny. You build the base while consumer culture screams at you to buy the nicer version, finance the upgrade, add the subscription, take the trip, and call it self-care. Some spending really is worth it. This is not a lecture about becoming the most joyless person at Target. Money is supposed to support a life, but if every dollar goes to present comfort, future you gets whatever's left. And in America, whatever's left often means a suspiciously small number after housing, healthcare, cars, kids, taxes, food, and the dozen little fees breeding in the dark corners of your bank statement. The investor who wins is not the one who feels rewarded in year 2. It is the one who is still buying assets in year 10. So here's the practical close. First, separate emergency cash from investment money.
Rent, food, bills, insurance, deductibles, and near-term obligations do not belong in the stock market. Build the buffer so volatility does not threaten your actual life. Second, choose a monthly contribution that can survive a normal bad month and automate it. If $500 breaks every time life gets slightly annoying, make it $350 and keep it alive. Consistency beats a heroic number that disappears by spring. Third, schedule one annual increase, even 1%. Put it on the calendar. Tie it to a raise, a debt payoff, a subscription cleanup, an insurance requote, a cheaper phone plan, or a grocery swap you can actually maintain. Then review the system once a year. Contribution rate, account type, match, asset mix, fees, emergency cash, and time horizon. That is the job. Not predicting every recession headline, not waiting until investing feels exciting, not measuring your future by the mood of today's account balance. Early investing feels unrewarding because the first stage is mostly base building. It looks slow because the account is still too small for ordinary market movement to feel loud in dollars. But if emergency cash protects your real life, automation keeps the habit alive, and annual reviews keep the setup pointed in the right direction, the quiet years start doing a job that cannot be rushed later. And when the portfolio finally carries more weight, the reward is not just a bigger number. It is knowing the system kept working through the years when the number had not earned your attention yet.